Welcome to Steve Savant's Money, the name of the game. Hi everyone, I'm your host, Steve Savant, syndicated financial columnist and money gamer extraordinaire. Today we're talking about the new strategies to reduce taxes with nationally recognized product taxation expert Ken Davis, CLU, CHFC, CFP, and CPA. Ken, welcome to the show.
Stephen, great to see you.
Now, I think a lot of our consumers, they recognize CPA, and some of them might recognize CFP, Certified Financial Consultant. But you have two other ones there. Can you just describe them real fast?
Yeah, the CLU is a Chartered Life Underwriter designation from the American College in Bryn Mawr, Pennsylvania, and the Chartered Financial Consultant is another one from the same college. They're actually more in depth than the CFP. They're not as well known, but they're actually about twice as many courses.
Wow. Well, you're highly credentialed. I see you online with your articles, blogs. I really appreciate you. And one of the things we like to have you on the show is, Ken, because you talk normal consumerese. We really appreciate that about you. And of course, we're in 1040 season now, so we're preparing our taxes. We've got about a week. We still got some time here if we want to make some adjustments. And if you hear some of the ideas that Ken and I are going to bring to you today, you could file an extension. You may still have to pay your taxes due right away on time, but we may be able to give you some ideas that could really help. Ken, I want to talk about the 3B freebies. I want to talk, they're 3B freebies. Exemptions, deductions, credits. For our consumer education, up our game, walk me through basic ideas. Start with exemptions.
Well, and I'm going to use both an exemption and a deduction because they're pretty much the same impact. Exemptions have to do with being 65 or blind and that type of thing. And there's so much that the government gives you as a deduction of sorts. A deduction basically means it reduces your taxable income by, $100 reduces taxable income by 100. If you're in a tax bracket of 25%, that means $100 of deduction saves you $25 in taxes.
Now, when you talk about taxes, I notice that we're in what they call, I think it's called, help me out, progressive tax bracket, marginal tax. They keep getting larger with income.
Yes, it's an incremental system. And there's a lot of myths surrounding that. People think, oh gosh, I'm going to push myself with one more dollar into a higher tax bracket, then all of my prior income is going to be taxed at the higher rate. And the answer to that is no. It's a stair step. The first so many thousands of dollars is taxed at this rate, and then it goes up, and that's taxed at that rate. When you hit that final marginal income tax bracket, that final jump up, that last tax rate, it's only the amount of money that exceeds that threshold that's taxed at that high rate. That's important for our viewers to understand.
I noticed that sometimes exemptions and deductions can get you in a lower marginal, bring you down one step. So it's helpful to be able to know how to manage your own deductions and your exemptions.
Well, that's exactly right. For instance, if somebody is managing a portfolio and they're trying to decide whether they have taxable bond income or tax-exempt bond income, you can overdo it. You can switch so much money out of your taxable interest to the tax-exempt that you actually bring your marginal tax rate down to the point where you're actually doing yourself harm. And the fact is that taxable interest generally pays higher interest rates than tax-exempt, because the municipalities that issue tax-exempt instruments know that they can pay you a little less because you're getting a tax break. So there is a break-even point, and you really should be running it through some software saying, if I move from here to here, where's that sweet spot? Where do I cross the line?
And we see now a lot of consumers are using basic softwares for the 1040. How sophisticated have they become?
Well, I think, it's a comment on the industry. I started back in the 70s when we did a whole lot of tax projections. People were really dependent on their CPAs to run numbers for them. Of course, the tax system was a whole lot simpler back then, and you could answer questions more easily. Today, there's TurboTax and other types of tax software out there. Not to give anybody a help on the show, but or an endorsement. But a lot of people run their own taxes, especially people with just a simple W-2. They just buy the software package, they pump it out and do it themselves. A lot of people say, no, I'm not good with numbers. I'll just use my tax preparer or tax CPA.
Well, what about credits now? A lot of people are hearing about credits. Obamacare right now, that's how more people say, I didn't know what credits. So people come to me, not so much about Obamacare. They say, Steve, will I qualify for Obamacare credits against my insurance premium? So I want you to talk about that for a second, just to define credits for a moment, because I think a lot of us are now waking up to this as in the public domain.
Well, credits are a really important thing to understand because remember I said in my example, $100 of deductions for a person in a 25% bracket save $25 in taxes, which is great. However, if that deduction or exemption was now $100 in a credit, it's a dollar for dollar reduction. So $100 in credit reduces taxes by 100 as opposed to 25. So if you have a choice between a credit and deduction, by all means, we want the credit. And what's interesting is that is much better for people in lower tax brackets. Okay, the people in higher tax brackets get more benefit from a deduction. People, like a 15% bracket, still get a dollar for dollar reduction instead of just $15 or $25 or $30, depending upon your tax bracket.
There's so many moves on the checkerboard when you're talking about 1040 business, and if you learn how to artfully use exemptions, deductions, and credits, you can really modify and make the call on your taxes and actually create more cash flow.
Well, and the nice thing, if somebody does get comfortable with a tax software, they can run what-if calculations. They can say, gee, this is my situation now. What's my tax? If I were to make a contribution to an IRA, if I switch from taxable bonds to municipal bonds, if I made these changes and change these line items, what is the bottom line change in my taxes? And you take the first tax minus the second one, and that either has increased or decreased your taxes and tells you how useful that is. And you might think, well, gosh, I'm in a 25% bracket. All I have to do is multiply it by 25%. No. There's so many different moving parts that adjust whether credits and deductions are useful or not. You really have to run it through software or hire a tax preparer.
When we come back from the break, we're going to talk a little bit about this because I want Ken to manage adjusted gross income and modified adjusted gross incomes. That's where the tale is going to be told. We'll be right back in about 30 seconds.
Take a close look at your hard-earned dollar. How do you think your money's doing? Are you keeping an eye on it? Is it protected from taxes, inflation, and market risk? Over time, those Washingtons could become Franklins. With tax-advantaged indexed universal life, from one of the largest distributors of indexed universal life, Ash Brokerage.
Well, welcome back to our second segment. Ken, give us the yin and the yang. Everybody, we almost got used to adjusted gross income. The populace, we were kind of understanding a TurboTax, as you suggested. AGI, I'm on the front page, bottom of the line. Now I have to bring back and import a whole nother bunch of numbers for modified adjusted gross income. Talk about those two.
Well, it's become very confusing, and that's really why you need some software. We used to worry about what is taxable income and what's your tax bracket. We multiply the two and it's easy, right? Well, unfortunately, that's not the case anymore. What's happened is the government says, oh yeah, I'll give you this deduction, this exemption, this credit, and aren't we cool? And then they take it away. And how do they take it away? They have formulas based on adjusted gross income and modified adjusted gross income that will either limit or eliminate the use of the deductions, the exemptions of the credit if you make too much money. Okay? And when they say if you make over a certain amount of money, this is going to happen to you, what they're really talking about is adjusted gross income or modified adjusted gross income. AGI simply is the bottom of page 1 of your Form 1040.
Adjusted gross income.
Adjusted gross income is on the bottom of that page. That's a number before you take itemized deductions off on the tail end on page 2. And so it's really important that we look at that number. And of course that number is higher because it's before deductions, the itemized deductions and the standard deduction. Modified adjusted gross income is even worse. They take AGI and say, well, this isn't high enough. We really want to come after you. So we're going to add in half of your Social Security income. We're going to add tax-exempt municipal bonds. Get that? What we thought were tax-free actually adds to a formula that causes you to reduce your deductions, credits, and exemptions, thereby increasing your taxes. See how complex this is? Can't even say it in a simple way.
Well, Ken, I know last year now they kind of took care of some of the problems we had with the alternative minimum tax. This tax that kind of tries to catch you, but it sounds like you're saying more than the ATM, it sounds like the modified adjusted gross income is much more the culprit.
Well, that's right. AGI adds back in several items, and to make it even more confusing, they use the same term, modified adjusted gross income, in several places in the Internal Revenue Code, and the definition of MAGI is different for each one. It's not the same items being added in, and so you have to look at each item, item by item, and add back in those amounts. And again, that's why you go back to software or employ a tax preparer or CPA to actually run the numbers and say, if I do this, what is the result?
I noticed in the news the other day, they're talking about people who have went on the Obamacare site, their I think it's health.gov or whatever it is, and they went on the site and they plugged in their numbers and they were trying to figure out what could they estimate that they're going to get back as a credit. And there's formulas out there in several sites that are not government that are, I think, a little bit more accurate.
Right.
Now, they went ahead and did this, and they were hoping for this credit, and they thought, looking at their AGI, they had the credit made. But by the time they took on the modified adjusted gross, Ken, they didn't get a credit. What happened?
Well, it's the modifications. It's the M on MAGI, modified adjusted gross income. You and I have laughed about the fact that maybe it should be MAGIC, MAGIC, which is modified adjusted gross income confiscation.
Confiscation.
Right?
Yeah.
And the C. But that's basically what they're doing. And what's really interesting about that is a lot of lower income people have kind of ignored the tax laws because that's only for rich people, right? For those people above that 50% level that are paying taxes. Well, now they're impacted on the credits they get towards their Obamacare premiums. Now they're impacted by these formulas, and these poor people, even they have to worry about it.
Ken, I've heard you talk and teach about this before. Not only does modified adjusted gross income kind of mess with your taxes, but there are stealth taxes embedded in the code that are not clearly seen. And so a lot of people, as you've said, mistakenly thinking, well, the rich people are the ones that are fronting this. They have hassles. It sounds like middle America now is exposed to not only Obamacare, not getting the credits they thought they were going to get from Obamacare, but now they also have these embedded stealth taxes built inside the system that are even beyond modified adjusted gross.
Right. I mean, think about it. The people on Obamacare, by definition, don't make a lot of money. These are people that are struggling financially, and they're now being hit by these formulas. Even more pervasive, and we've talked about this on other shows, is the taxation of Social Security income hits not the rich people, which is what it was intended to do back in the early 80s, but it affects, and again, not just the middle class, but the lower middle class are now having their Social Security income taxed and paying taxes on it. So this is hitting every segment of society, from the lowest rungs of the ladder for Obamacare, then to the middle class for Social Security. Then we get into the higher earning people with Medicare premiums go up based on modified adjusted gross income. Medicare premiums, they're not even a tax, Stephen, and yet they're using tax concepts to increase your Medicare premium. I'm sorry, but that's a tax. It's not a premium. It is an additional tax. And then for the ultra wealthy, or what many of us would define, then you get into the Obamacare investment tax and some other types of things. So this is happening all the way up and down this rainbow of different kinds of tax payers. We're all being impacted by these really crazy, difficult rules to get our arms around.
Well, think about this. Remember, we're asking you either using TurboTax or you're going to a CPA or maybe an enrolled agent to do your taxes. These are some of the things you can still take care of all this week while we still have time before April 15th. That's our show for today. I want to thank Ken Davis for being my special guest and today's Money Mentor. And before moving forward with any of the ideas on the show, always consult your tax advisor or legal counsel. And as the good Reverend John Wesley once said, make all you can, save all you can, give all you can. I'm Steve Savant. We'll see you next week.